Today on the We Invested podcast, we have Bradley Clark, and he is the founder and owner of Clark Asset Management. Bradley, how are you doing today?
I'm great, thank you, and thank you for inviting me on.
Yes, sir. Thank you so much for joining. Um, I mentioned earlier that I'm really looking forward to this conversation and just learning more about this company that you've created and built. So I'm excited for this episode today.
Great, I am too. Thank you.
And before we get started, would you just mind letting the people know how they can find you on the internet, either via your website or your social media?
Sure. So my website is just my name, Bradley Clark, and it's Clark without an E.
Awesome. So let's just start from the beginning and talk a little bit about, where you're from and where you grew up.
I grew up in Washington, D.C., which I loved. Kind of this, there's a lot going on in Washington, and I always got a kick out of my hometown newspaper being the Washington Post. My parents were both civil servants, so I haven't lived there in a while, but definitely loved my time in D.C.
And so how would you say that growing up in DC impacted your outlook on life and success?
Wow, what a good question. Gosh, that's a great question. I think it made me more aware. I mean, it's a pretty cosmopolitan city, right? So I got to go to high school with the kids of diplomats, and I feel like I was exposed throughout my childhood to the good and the bad of the U.S. government and the three branches of power. And tons of embassies were close to my house, so I think it just kind of raised the general awareness of the United States in a kind of in a global community. And so I think that gave me some perspective and some interest to study and travel and things like that.
Did it ever instill in you a sense of, um, that was it ever important for you to do what you felt was important and to chase your dreams and to go out and accomplish these large achievements that you have?
So I would say kind of at the beginning, but then not, but much more so about 6 years ago. So I'm 53, and I would say for the first chunk of my life, I was very achievement oriented. I went to a private school, and the whole school was geared towards getting kids into brand name universities. And I feel like I just kind of went along with that, right? So where achievement was important and going to a great college was important and getting a good job and like you kind of checking the boxes, if you will. So I kind of went through the motions for years, and I learned a ton and acquired skills and what have you. But it wasn't really until 6 years ago when I made the decision in mid-career or late career to start my firm. I would say that it was as of that point that I feel like I'm truly following a calling or a dream or a passion.
And I just want to kind of fast forward and transition to you starting that firm, and just the mindset that you were in. But before we get to that, I want to ask, what is Clark Asset Management?
It's a great question. So we're a wealth management firm, and to me, wealth management is the combination of investment management and financial planning. Both services provided over time and ideally provided in an integrated and cohesive way. So we serve about 110 clients, and again, we manage about $300 million of assets, but it's very planning focused. So lots of tax planning and insurance planning and retirement planning, college planning, estate planning. We don't draft estate documents, but we certainly can identify gaps and work with estate planning attorneys. So that's it. It's a pretty simple concept, but it's a vehicle through which I get to I get to imbue the service and the pricing and the client experience and everything with my own beliefs and values. And that's just been very gratifying.
Absolutely. And how did you get started in this industry? How did you get started in the financial space? What was that initial spark?
Well, it's funny. I think when I was 12, I'll never forget this. I was on an Amtrak train to visit my grandparents, and my mother taught me about Vanguard and taught me about the power of, compounded growth. And so I was very interested at that point, and always just very interested in financial planning, but never did it as a career. Ended up at Stanford Business School, and my favorite course was called Modern Portfolio Theory, where I studied under a Nobel Prize winner named Bill Sharp. And that's when my eyes were really opened about actively managing mutual funds versus passively managing them, and the economics of the industry and the conflicts of interest. And so I actually had a fair amount of disdain for the financial industry in business school. Then I ended up as the publisher and chief marketing officer at the Motley Fool,
Oh,
which
wow.
allowed me to get reconnected with all of this, um, and had a great time there. And finally got up the guts to recognize that if I didn't try this on my own through my own firm, I would regret it. Right. And sometimes you get to the point in your life where, if you don't try something, you'll regret it forever. And that spooked me to the point where I just quit my job and took a huge risk because I had never actually practiced as a financial advisor, and called up my best friend and said, will you be my first client? And he said yes. And I haven't looked back since.
No, that's incredible. And it takes a lot of courage to make that transition at any point in life, and to just have that ability to believe in yourself and take those calculated risks. But what I want to ask you is, how was that transition for you when you were going from having your uh 9 to 5 job, your day job, and then to fully working for yourself? Was that moment ever intimidating for you? Did you ever have any reservations about making that move?
I didn't have any reservations prior to making the move. I will say, that the first few years of launching something can be lonely, and it can be, you definitely have moments of self-doubt where the highs are very high and the lows are very low, but there's this feeling at the beginning that it's just you. There's no safety net, there's no team. And so, those first 2 or 3 years, it definitely is, it's kind of volatile in terms of kind of what's going on in your mind. I guess I would argue at this point I've built out a team, so there's camaraderie and there's teamwork, and I can lean on others, and so it's much more kind of even keeled at this point.
So what are some ways that you gained your business IQ to find out the best business model, or to understand the hiring process, and who you need to bring onto the team to help you and to help the team flourish? How did you go about gaining your business acumen? Was it through school, which you went to Stanford as well as Harvard? Was it through mentorships, building relationships, or trial and error? Which ways or even combinations work best for you to help you gain a knowledge and understanding for operating a company?
Yeah, it's such a good question. I think I had always had a chip on my shoulder in as much as I have these good educational brands on the resume, and then I did boutique strategy consulting. And the issue with both of those is, yes, it teaches you to be a very good kind of critical thinker. And you can, the more clearly you can think, I think the better, right? You can structure problems, you can articulate a hypothesis, you can kind of communicate well with others. However, the chip on my shoulder was, it was all very theoretical, right? And it's kind of like, just because you go to good schools or you work in consulting doesn't mean you actually have the skills to operate something. Because all
Mhm.
you're really doing is playing with ideas or giving other people advice. And so I think I was always chomping at the bit to show myself or other people that I could actually operate something. So the only way to get the exposure to that was to leave consulting and work in small businesses. The first thing I did after consulting was co-found an internet company called military.com with a guy from my consulting firm. And we raised all sorts of money. We made all sorts of mistakes, but it was kind of, this was in the middle of the dot-com boom and bust. But that type of practical experience, and you just make so many mistakes, but then you start to see which decisions made sense, which didn't. So slowly but surely, I got the operating experience after, you could argue, I left the kind of the ivory tower.
Absolutely. And in the financial industry and in every industry, every client is different. Everyone has individualized um issues or problems that need solutions. But I want to ask, what are some of the common themes, if there are any at all, that you see when you're onboarding or helping or working with a new client?
Yeah, so we decided to niche our practice. And I think one of the things I've learned, not just in financial advice business, but in business in general, I got this advice a long time ago, which no matter what your business is, especially when you're starting off, keep niching down and niche down and niche down and niche down until it is making you very uncomfortable.
Mm,
And that's when you know that you've niched down enough. Like in the 50s and 60s, generalists could flourish in our economy.
mm-hmm,
Now it's about specialists. Okay. And there's another piece of strategy advice I got one time, which was, you have a good strategy if you say no to a bunch of ideas that other people are going to make a bunch of money with.
wow.
So the discipline to pick a lane, a very specific lane, and stay in that lane is a huge thing that I've learned, and I think younger entrepreneurs could benefit from. So to that end, a few years ago, I decided to bet my company on becoming the leading fixed flat fee retirement income expert in the country. Right. And so my ideal client is the following person: 55 to 65, 2 to 5 years away from retirement, 2 to 6 million in liquid assets, savvy with investing, but has gotten to the point where they realize that accumulating assets is actually simple. It's not easy, but it's simple conceptually. But when you start to reposition for retirement and segue into the decumulation mode, there are a new set of 6 or 8 or 10 complex planning topics. And so 9 out of 10 of the people that contact me are getting close enough to retirement, or they just retired, and they're finally willing to raise their hand and say, I've been doing this on my own, but I'm finally ready to admit that I need to collaborate with somebody who specializes in repositioning assets so that they can start to generate, reliably generate income to support somebody for the rest of their lives as their career winds down. And that's our niche. And we're growing very quickly because we have married a pricing model, which is a flat fee model, which I'd love to talk more about later, with a retirement income expertise. Almost all the other retirement income experts that I compete with are commission-based annuity salespeople. And almost all the wealth managers I compete with are charging 1% of assets. Well, if you've got $3 million or $4 million, 1% of those assets is 30 to 40 grand a year. And my pricing is 9,500 for everybody. So it turns out I've got a defensible competitive positioning, and we're growing quickly because of it.
No, that's incredible. And you mentioned that your ideal client is someone who's 50 to 55 to 60, um, close to retirement, and they're a savvy investor, so they've done most of it themselves. Do you notice any difficulty with clients being uh, clients having reservations about turning over the reins to their investments in their financial future? Does it take continual education? What does it take to get that client comfortable with leaving this in your hands, with it being something that they've grown from scratch, so to speak?
No, I think that's absolutely the right question. So I read this Forrester segmentation study years ago that said there's three types of investors. There's soloists, that's
Mm-hmm.
do-it-yourselfers. There's delegators who basically aren't interested in money, and they're kind of afraid of the decision. So they just want somebody else to make the decisions that they trust, right? And then in the middle is the validator, the person who wants to collaborate but wants to stay involved and wants to make the decisions. Most of my competitors have been preying on delegators. Delegators are price insensitive and will easily hand over 1% of $3 or $4 million, and they may not even know what they're paying. Our target client is somebody who has been a soloist for years, but then transitions into being a validator. Some of those folks are happy to turn over the reins, but they want to understand and agree to the strategy. Some of those folks still want to make investing decisions at the security level, and that's okay, right? So the beautiful thing about our pricing model is we don't need to capture your assets in order to be paid, right? So whether you bring the money under our management or not, you're going to pay the $9,500 a year for our advice, and either we're running the money for you, or we're just looking over your shoulder and giving you security level advice. But it can take time. So sometimes we get people who start off with us, they want to keep making their investing decisions, but then within 12 or 18 months, we've built up enough trust that they just hand over the decision making to us.
And just speaking on that flat fee that your firm charges, what is the idea and the vision behind that? And how can that flat fee benefit the company as a whole?
Benefit my company.
Yes.
Yeah, it's interesting. I'm a little bit idealistic about this point. It's the fee. I think the fee benefits my clients more than it benefits us. So
Mm-hmm.
here's the deal, and this is kind of my soapbox issue. If you think of if you think about certain professions, there are certain professions referred to as helping professions, right? Like
Mm-hmm.
teachers, doctors, nurses, social workers, psychiatrists. Those types of professions are often known as helping professions. If you contrast that with the financial services industry, I would argue that we're more of an industry than a profession.
Okay.
An industry distributes products. An industry often has incentive in the form of commissions or other things like that for the distribution of their products. Okay, that's how our industry has evolved. It used to be that people made money on commission selling financial products, mutual funds, whatever. The problem is when you combine advice and commissions, it creates a troubling conflict of interest. So now the prevailing compensation scheme is a percentage of assets. Turns out there's two problems with that as well. One is if the portfolio is large, the fee you're paying is very, very, very large. And two, even the percentage of assets fee has troubling conflicts of interest in it, right? So let's say I'm managing 4 million of your dollars, and then you say, "Hey, Brad, I'm thinking about buying a vacation home." Well, if you take $1 million out of the stock market to buy a vacation home, and you're paying me on a percentage of assets, then my compensation has just fallen from 40,000 to 30,000. Or if you want to pay off your mortgage, or if you want to if you're thinking about deferring Social Security, right? So or starting a business, we can come up with any number of examples of how the percentage compensation model creates a conflict of interest between the client and the advisor. So, so I believe not only do I want to serve clients, but I also want to do my part to help turn this industry into a profession. And I think by charging a fixed flat fee, I can help clients by saving them money. I can clear out all these troubling conflicts of interest. The last thing you want is conflicts of interest between you and your financial advisor. We're talking about your life savings and we're talking about your financial security. We're talking about trying to help you achieve your life goals. And do you want conflicts of interest getting in the way there? And I would say that you would not. And so I want my firm to be an example to younger advisors to say, hey, you can actually make a living with a pricing model that is much more consistent with a helping profession. You don't have to keep turning the crank of the 1% assets under management model. So this is I'm very passionate about this single fixed flat fee where everybody's paying. It's very democratic. All my clients are paying the same fee, and I believe that it's in my client's best interest for them to do so.
And I think that's a very interesting approach to the financial services space, because your only goal is not just helping the clients, but it's also helping the industry as a whole, and it's helping to reshape how people think about finances and how they approach um you know asset management firms from now to beyond.
Yeah, I think that's right. I mean, I'm trying to build a futuristic, enlightened wealth management firm. I mean, our team is virtual. We don't have the mahogany desks. We don't have the golf magazines and the wine and cheese parties. Our pricing is radical. We're very technology oriented. And I believe that over the next 10, 20, 30 years, more and more wealth management firms will end up looking like ours.
That's incredible. I mean, and while I was doing my research, I came across something that sounded extremely interested to me, and I wanted to ask you more about it and ask if you could expand on it. And that is the three investing games. So would you just be able to kind of elaborate a little bit more on what exactly that is?
Sure. So I have a book coming out in January, and in the book I refer to, three different games that somebody could play within investing. I kind of tee those up. I used to work for a guy who referred to, and I don't think he came up with this, but he referred to the stock market as the greatest game.
Mm.
So if you think about the stock market and what attracts people to it, the risk taking, the gambling, the analysis, the predictions. If you put $100,000 into an investment and it becomes a 10 bagger, 10 bagger means it goes up 10 times in value. 100 bagger goes up 100 times in value. I mean that can be incredibly euphoric and exciting, right? So the first game is the stock picking game, where you try to outthink and outsmart the stock market by picking securities that end up clobbering the returns of the broader stock market. That's the first game. Um, the, as exciting as that game is, I actually don't think that game is terribly healthy for most investors. Even Warren Buffett has come out and said a retail investor should just purchase an S&P 500 index fund from Vanguard and not bother with stock picking. Now, with that said, if you put 80% of your assets into the Vanguard S&P as an example, and then you take 10 or 20% and you have fun with that in your Vegas account or your hobby account, fine. But it's pretty dangerous to take all of your assets and being so undiversified as to pick individual stocks. As you may know, there's a handful of super stocks that drive the returns of the market, right? Tesla, Amazon, Netflix. There's tens of thousands of securities but most of the returns are driven by a very small number of stocks. And if you pick 30 stocks and you miss owning any of the super stocks, you're in trouble. So the way to own the super stocks is just to own all the stocks,
Mm-hmm.
right? And you do that through a simple low cost, Vanguard index fund. So the first game is stock picking. I don't think that makes sense for the bulk of your assets. If you broaden away from stock picking, you get to a broader game that I call portfolio management, and that's what I studied, under Bill Sharp, and that starts to bring in powerful concepts of owning lots of asset classes and the inverse correlation of the asset classes, which basically says when asset class A zigs, asset class B is going to zag. And over time, you benefit greatly from exploiting those inverse correlations between asset classes. So if you take a step back from stock picking and you start to manage the portfolio and the characteristics of the portfolio instead of the characteristics of the individual securities, that game makes more sense to me. And I call it a game because it's still very numerical and there's still decisions to make. There's still things to tinker with. If you take one step further back, you get to the third game, which I think is the game that takes the most skill, which is the wealth management game. So here, it's no longer just about the portfolio. You actually put yourself or your client in the center and say, what are the client's life goals? How do we translate them to financial goals? And then which plays in the playbook can we use to help them knock down their financial goals? So this brings other stuff in, like asset allocation and tax planning and charitable gift planning and estate planning, where what you're really trying to do is maximize after-tax risk-adjusted wealth subject to a client's, life goals and preferences. That's a more complex game, but a game that actually requires far more skill than stock picking or portfolio management. So I guess the last way to conceptualize this is concentric circles. So there's a small dot in the middle. Some people focus on that, which is stock picking. If you're
Mm-hmm.
focused on that, I'd like to see you broaden it to the next concentric circle, which is portfolio management. Once you feel like you understand that, then broaden it one more time to a true holistic wealth management mindset. And that's ultimately the most productive game to play, whether you're a do-it-yourselfer or you decide to collaborate with somebody.
No, and I think that's an incredible way to break down and simplify the idea of investing. Because I mean, you mentioned this earlier, but a lot of this is simple instructions, is simple, but it's not easy. So being able to stay, um, I guess with game three, when you talk about the overall financial planning, it's we can enact simple plans for clients, but the difficult part is staying the course, or staying consistent with that plan and not deviating from that plan unless certain life events happen. And then as far as picking stocks, I think that's a great way to just introduce it to people, because that is most people's introduction into the world of investing. They hear about these like guru investors, and in the person who invested in the stock when it was $5 now it's worth $2,000. So everybody wants to try to um achieve that and grasp that have that same outcome. But just giving the practical advice of stepping back, stepping away, and zooming out a little bit to provide the true long-term growth in the long-term investment gains. I mean, I think that's a great way to look at investing, and a great way to help people understand it through gamification of the financial industry.
Yeah, and I love the gamification motif, and we've done some of that, but I'm sure we can do more. I mean, gamification is so attractive to everybody's brain, right? Because our
Mm-hmm.
our brains, whether it's the dopamine or the idea of achievement or human brains are very focused on numbers. We love predictions. We love games. And
Absolutely.
the industry has been built on the quarterly. Let's look at the portfolio quarterly and let's do a performance report. And that's
Exactly.
understandable. However, looking at your portfolio quarterly and trying to make adjustments quarterly, you could argue is exactly the wrong idea, right?
Mm-hmm.
You want to invest for the long term and you don't want to overreact in the short. If the market goes down 20%, let's say one spring, and then you meet with your financial advisor after it's gone down, like staring at those performance reports too much and over interpreting them may make you to make the may make you make the ultimate mistake, which is to sell your investments right after they fall.
Mm-hmm.
And people did that in '08, right? And people did that in COVID. And I mean, talk about shooting yourself in the foot. If you bail out right after a correction, I mean, you'll never catch back up to the market.
Absolutely. And then another thing with, individual stock picking, I still do enjoy doing that myself, but I also invest in these ETFs as well, just to take some of the thought out of investing and just kind of make it a little bit more automatic, because or a little bit more automated. But you know, when you're living life and you have a daily life, for the average person, you rarely have time to do the full deep dive and research these companies and understand what they're doing and look at the balance sheets and look at their financials and look at the management team. Like, you really don't have that time. So by investing in these ETFs and looking at it on a broader scale and really diversifying, it just provides more safety and reduces the risk for you, and it still gives you your time and freedom back so you can do other things that you enjoy.
Yeah, I completely agree with that. I mean, what's hard for a lot of people to wrap their brains around. Think about a surgeon. So a
Mm-hmm.
surgeon has gone through a lot of training, right? And presumably you would agree, most reasonable people would agree that a actual surgeon who's gone to medical school and then 7 years of residency and internship, whatever, who's operating on your heart will operate on your heart more effectively than somebody than a barista at Starbucks or a mechanic or an attorney, right? I mean, I think we all understand that. What's weird
Absolutely.
about investing is somebody that's been at it for 30 years and has a PhD and does it for a living. There's a lot of data that shows that they are no better at picking an individual stock than a chimpanzee or a rabbit or a child, right? And this is somewhat controversial. I mean, I think the data is clear that that's true. But one of the big things you need to decide as an investor is, do you believe it? Do you believe that you are smarter than the stock market and that you are smarter with all the millions and millions and millions and millions of people on the other side of the bet that you're making?
Mm-hmm.
And at Stanford Business School, I had a class called Creativity in Business. It was a wacky class for an entire week. Imagine 40 Stanford Business School kids, at an elite program, um, sitting there practicing saying, "I don't know." And humility may be the investor's greatest ally. If you
Mm.
actually believe that you're smarter than the person on the other side of the trade, I'd be careful about it. I'd watch out.
That's a very interesting way to look at it, and something that I hadn't thought about before, but yeah, very controversial. But I mean, if the data is there and if the data shows, but yeah, man, just to think that you can beat the system or to think that you can beat the actual market, that's dangerous territory.
Yeah, and so have fun with it. I mean, you know,
Absolutely.
like knock yourself out. But I would. So we work with some clients, and we use a core and explore motif where 80 or 90% of the assets are core assets and are invested in a diversified way through Vanguard ETFs or what have you. And then, as I said before, 10 or 20% for some clients are explore assets. And that's where the
Mm-hmm.
client may get more exotic, right? Angel investing, private equity, stock options,
Absolutely.
derivatives, partnerships, individual securities. precious metals. I mean, there's an infinite list of things you can do with your explore category,
Mm-hmm.
but I would just not make the whole portfolio explore.
Absolutely. So we've talked about, um, you know, building up these assets and building up this wealth. Now I want to ask you more about the 4% rule and how that works and what exactly that means.
Yeah, so this is one of the most important findings in the last 50 or 60 years for financial planning. The 4% rule is a heuristic, which is a fancy way to say a rule of thumb or something that you could do on the back of a napkin.
Mm-hmm.
So here's what it says. It says, let's pretend you got 2 million bucks. If you have $2 million and you retire with 2 million, the 4% rule says this: you can safely withdraw 4% of the starting value of the portfolio in the year that you retire, adjusted for inflation the rest of your life. So let me give you an example. You retire at 60 with 2 million. 4% of 2 million is 80 grand. What the 4% rule says is you can withdraw 80 grand from that portfolio and then increase it the following year by inflation. So if inflation's 3% in the following year, instead of 80 grand, it would be 82,400. And then the next year would be another, 3% increase, et cetera, et cetera. That you can just woodenly do that with confidence, no matter what the portfolio is actually doing. So it's called a safe withdrawal rate, right? So you retire with 2 million, maybe in the next year the market goes up 20%, maybe in the next year it goes down 20%. The 4% rule is considered a safe withdrawal rate, which means you can just take that 80 grand out and do it with confidence for the rest of your life, no matter what the portfolio is doing. Okay, so it's a very powerful back of the napkin. Is that the same as a rigorous financial plan? Absolutely not. But it's a simple back of the napkin to get you in the ballpark of what you could probably afford to take out of the portfolio over time. Now remember, 80 grand, depending on where it's coming, what type of account it's coming out with, Uncle Sam's going to want their piece.
Mm-hmm.
So they may take 10 grand or 20 grand out of it. And then imagine paying a financial advisor 1%. So if your portfolio is 2, you're paying them 20 grand a year. That comes out. Right.
Mm-hmm.
So recognize that it may not be 80 because you have to pay the federal government, you have to pay your financial advisor. And obviously, if you have a pension, or you're going to have a social security benefit, there's other streams of income you can rely on in your retirement. But that 4% rule is very helpful. That they built that through back testing. They went for the last 120 years. They examined every 30-year period, and they assumed a 60-40 portfolio, and they kept crunching the numbers to derive that safe withdrawal rate. Okay?
Absolutely.
So if you withdraw 5%, it'll usually work, but when they back tested it, it failed a couple of times. So they kept going down until they found the rate that never failed, and that was the 4% rate. Now that's a back test, and some people trust back tests, and some people say, well, is history really going to repeat itself? So that's why I think it's helpful, but it should not be determinant. I think in addition to that heuristic, you also want to use advanced planning software and run Monte Carlo simulations and, test the resilience of your plan in a more, rigorous way. One of the things that a lot of our clients fear is $500,000 going to a nursing home. Medicare does not cover long-term care costs. So if you end up in an Alzheimer's unit for 3 years, very expensive, but Medicare is not going to pay that bill. So this can destroy financial plans. So when you're retiring, one of the questions to ask is, how resilient is this plan to the possibility of landing in that Alzheimer's unit for a few years? These are not things that we want to think about. They're not pleasant. We don't want to like to think about our death. We don't like to think about the possibility of our incapacitation. So most people just don't think about them. A good financial advisor should be able to think catastrophically on behalf of their client so the client doesn't have to.
So the markets recently have gone down by about 20%. How have you been helping your clients? What is your focus been on helping your clients um address the markets and cope with the markets and how they've been performing?
Yeah, it's a great question. We're lucky because we're so transparent on our website about our approach and our beliefs that we almost always attract clients who believe what we believe. So when the stock market corrects, we really don't get very many worried phone calls. We don't get clients panic selling because they believe what we believe. Now, having said that, we do crack people's financial plans open regularly.
Okay.
And after the decline, we cracked open most people's plans. Most people's plans were strong enough that they did not need to make any changes to the assumptions in their financial plan. But we did have some clients where a 20% correction in the stock market did result in some revisions to the financial plan to restore the plan's strength. So, for instance, let's say Judy was planning on spending $30,000 a year on travel in retirement. By reducing that figure to 20,000 or 15,000, Judy was able to restore the strength of the financial plan after the 20% correction. And so it used to be that financial plans were 70-page documents that went in a binder and sat on a shelf that people never looked at again and were really generated by people trying to sell, insurance or an annuity product or something.
Mhm.
I think a much better way to conceptualize planning is not a 70-page document and not something that sits on a shelf, but something that's alive that you crack open once or twice a year and make small course corrections to. So in your audience, you may have sailors, you may have pilots, and the idea of making small course corrections to make sure you arrive at your destination is a very well-known concept for sailors and pilots. And I think that's a wonderful way for a client and their financial planner to conceptualize a financial plan. It's kind of bend, don't break, make small course corrections routinely so that you don't have to make a draconian course correction 15 years from now.
Absolutely. And just by providing that transparency, as well as having those open lines of communication, will certainly increase the comfort levels of any client and any investor, and really in any investing climate or economic climate. But what I want to ask you is, how do you define success as a founder and an entrepreneur?
Wow. You mean success for a firm?
Success for yourself personally as well as the firm.
Yeah, wow. Well, the first thing I would say for any entrepreneur is uh, please don't be overly influenced with how other entrepreneurs define success. We human beings, we always take cues from peers. So if you're
Mm-hmm.
setting out to be an entrepreneur, it's likely you're going to look around for cues from other entrepreneurs and look at what they're trying to achieve. And I would just say don't be overly influenced by that. You can look at it, but you have to try to find some intrinsic goal or intrinsic motivation, and instead of relying too heavily on kind of the goals of other entrepreneurs. That's the first thing I would say. So I really have, I mean, I guess I have three goals, right? One is first and foremost has to be to help my clients achieve the feeling of relaxed confidence in their financial lives. And I have a book coming out in January where the theme is relaxed confidence. and I get into some pop psychology stuff, obviously lots of financial planning stuff. But at the end of the day, am I selling investment management and financial planning? You could argue those are just uh, tools. Ultimately, why the company exists is to help people achieve that feeling of relaxed confidence. Because even people with tons of money are not necessarily enjoying the feeling of relaxed confidence. So number one has to be to help my clients achieve and maintain that feeling. Number two is to do my part to transform a shady industry into an actual helping profession. And we talked about that earlier. And then number three is to create an environment for my employees to flourish and learn and make a decent living and contribute and achieve their goals. So I think it's goals at three levels, and I think that uh, and anybody has to always be juggling these kind of multiple goals and short term versus long term. But that's how I would articulate it.
No, that's incredible. I mean, and you mentioned your team. You mentioned how important it was for you to create an environment for them to thrive and grow and just be the best that they can be. But I want to ask, how did you focus on building your team? What steps did you take to gather all of the right pieces?
Yeah. So first of all, it's something that I've got a spotty track record on. And I think that you know, if I grade myself over the past 6 years having started this company, and I don't know how many different courses there would be on the report card, but if there's like 8 courses and one of those courses that I'm taking is hiring, um, it's been a spotty track record, right? Hiring and training. So I've made some hiring mistakes. It's only recently that we've built a real training program. I have made some great hires. So despite kind of a choppy record, we do have some great people kind of working in the, you know, working in the company. Um, and I think it's another huge challenge for me and for many entrepreneurs is to start letting go and letting passing authority and decision making to other people. I mean, the URL for my website is my name, my photos all over it. It's my videos, it's my book. I mean, it looks like it's all about me, right? And so, starting to let that go and trust other people to do their jobs and give them, the tools and the authority to do their jobs. I mean, that's a transition, that entrepreneurs need to go through.
Absolutely. What does the future of Clark Asset Management look like to you?
Well, so I'm 53, and this is the last job I'll ever have. I want to scale the company, but it's not that I'm so ambitious that I want to take it public or anything. I'm really not interested in growing something to sell to another entity. What I'd like to do is we have about 110 clients. I'd love to scale it to 500 or 1,000 clients. So there's enough scale there that we can continue to reinvest in the business, but also that it puts us on a firmer ground to really kind of poke the bear, right? And by the bear, I mean the financial advice industry. I want the financial advice industry to be aware of us and our beliefs and our message and our mission. And so that requires some scale. Instead of selling the company, when I retire, what I'd rather do is slowly pass ownership of the company over to um, uh, my team, where I'm mentoring more junior advisors and helping them develop their careers, and slowly pass ownership over to other partners and leaders in my own firm, and then hand over the operations to one of them that are like-minded, who believe in the mission and the pricing model, what have you. And then I think in retirement, I'll no longer be operating the firm, but I'll still do podcast interviews and speak and take care of some of my clients, and then finally fully retire at some point. But even the traditional retirement is being challenged, right? So like when my dad retired, it was 30 years, and then you get your gold watch, and then you play golf and go fishing. And increasingly, people are having encore careers or they're semi-retiring. And the beauty of a practice like this is that I could step down from operating it, but still work 10 or 20 hours a week, but without operating the business and just speaking and writing and meeting with clients. So to me, that sounds like a very nice retirement or semi-retirement.
Absolutely. Bradley, thank you so much for your time today. I really enjoyed this conversation, and just learning more about the idea and the foundation of the company that you built. And before we get out of here, before I let you go, I just wanted to take this time to learn more about uh, your free book offer and how we can get our hands on that.
Yeah. So the book is called Be the Bird, which is an odd title, but there's a descriptive subtitle, and it's definitely chock full of planning ideas and strategies, but also insights about the industry and insights about mindset and confidence. It's coming out in late January. It will be available on Amazon to purchase. However, I do have an offer just for podcast listeners. So if you go to my website, bradleyclark.com/podcast offer without a hyphen, so podcast offer. Uh, if you would be willing to sign up for a free consultation with me, and there's no strings, it's not sales, it's just a chat about your own financial life, then I will send you a hard copy version of the book with no shipping and handling, no credit card, none of that nonsense. So that's the offer. If you're not interested in chatting with me, which I would completely understand, you could certainly purchase the book through Amazon. But bradleyclark.com/podcast offer.
Be the Bird. It sounds interesting, man, and I can't wait to get my hands on that. But Bradley, thank you so much for your time today. And I appreciate you, and this was a great interview.
Thank you so much, Wesley, and thank you for your obvious preparation and for your good questions. I really appreciated it.
Absolutely.